Hi, and welcome to a new video with Athena Quant. If you're a trader, doesn't matter if you're a seasoned pro or just getting your feet wet, you're facing the same big problem as everyone else. How do you actually make sense of all the noise in the market? How do you find a real objective edge when you're drowning in charts and opinions?
We're constantly asking ourselves this, right? Is this stock way too high? Is this crypto getting way too cheap? We throw around words like overbought and oversold all the time. But what do they really mean? How can we measure it with some actual confidence instead of just going with our gut?
And then the problem gets even trickier. Let's say you want to find the most stretched, the most extreme asset in your entire portfolio. How on earth do you compare a super volatile tech stock that costs hundreds of dollars with, say, a slow and steady gold ETF? It's literally like trying to compare apples and oranges. It just doesn't work. What we really need is some kind of universal translator.
Well, guess what? That translator actually exists, and it's called the Z-score. It is an incredibly powerful, yet simple statistical tool that just cuts right through all that noise. It gives us a clear, objective way to look at any asset on any time frame. It's the key to solving both of these big problems.
So here's the main thing you gotta get. A Z-score couldn't care less about the price in dollars or yen or whatever. It only cares about one single thing. How far away is the current price from its recent average? That's it. It's basically a measure of weirdness. How weird is this price right now?
And the formula behind it is just beautiful in its simplicity. All you do is you take the current price, that's your X, you subtract its recent average, or mu, and then you just divide that whole thing by the standard deviation, or sigma. All that's telling you is exactly how many standard deviations away from normal the current price is. That's the whole secret.
Okay, so what do these numbers actually tell us? Well, if a Z-score is somewhere between -1 and +1, that's totally normal territory. About 68% of all prices are going to fall right in that range. But when you see a score that's popped above +2 or dropped below -2, now you're looking at something statistically unusual. That price is way out in the outer 5% of all recent action. It's an extreme.
All right, so we can measure unusual, that's cool, but how do we actually make money with that? How do we turn that knowledge into a solid trading strategy? Let's get into the practical side of things and see how this builds into a really powerful framework.
The whole strategy is built on a classic, time-tested concept, mean reversion. It's a super simple but really powerful idea that when prices make a crazy move to an extreme, they tend to snap back toward their average over time. Seriously, just think of a stretched rubber band. It always wants to snap back to its normal shape.
This gives us a crystal clear game plan. When that Z-score drops below -2, the asset is statistically oversold. That's our green light, our signal to think about buying. Then we just hang on to the position as the price and the Z-score drifts back towards 0, which is the average. And when that Z-score gets close to 0, that's our signal to take our profits and exit. The same logic works in reverse, of course, for shorting overbought assets with a Z-score above +2. Now, if all of this is starting to sound a little familiar, it should. If you've ever used Bollinger Bands on a chart, you've already been looking at a visual version of this exact same idea. Those upper and lower bands, they're usually drawn 2 standard deviations away from that moving average right in the middle. And here is the big aha moment. The Z-score is the engine behind the Bollinger Bands. When the price touches that lower band, it's not some kind of magic, it's just math. It means the Z-score has hit -2. The Z-score chart just strips everything else away and gives you that one clean statistical signal. It's the deviation itself. All right, let's talk about the Z-score's other superpower. Remember that whole apples and oranges problem comparing a tech stock to a gold ETF? Let's see how the Z-score completely solves that and lets us find the most extreme opportunity across any market right now. The beauty here is that Z-scores are what we call a scale-free unit. They're standardized. So a Z-score of, say, +2.5 means the exact same thing for a $3,000 stock as it does for a $30 ETF. It means each one is 2.5 standard deviations above its own average. It just takes the price out of the equation and lets us compare everything on a totally level playing field. And a chart like this just makes it dead simple to see. By ranking a bunch of different assets by their current Z-score, we can immediately spot which one is the most statistically stretched out. So in this example, gold is way down at -2.3. That makes it the most oversold and a prime candidate for a mean reversion trade, while the other ETFs are just kind of hanging out in their normal range. No more guesswork. So let's bring it all home. By understanding and applying this one simple tool, the Z-score,
You've just given yourself a genuine statistical edge that you can use in any market you trade.
So let's just quickly recap the power of what you've got now. The Z-score standardizes all your data. It lets you objectively pinpoint those unusual price extremes. It gives you a rock-solid statistical reason for your trading signals. And maybe most powerfully, it lets you do that apples-to-apples comparison of any asset you can think of.
Let's circle back to this one last time because it's so important. If you remember only one thing from this, remember this right here. The Z-score is your tool for quantifying the unusual, for finding those moments when the market has stretched that rubber band just a little too far, creating a potential opportunity for you.
And that really just leaves us with one final thought. We've shown you the tool, we've shown you how to objectively measure extremes in pretty much any market, so the only question left is, where are you going to point it, and what opportunities are you going to find?